Yes, so feel good days, the little that we got in March, looks like they're over. I have made a few videos talking about that the green that we are seeing right now is just a fake out or a dead cat bounce. We are in trouble and now looks like market is getting ready for that trouble. Let me share some data and that shows we are in some rough waters and some analysts are calling this as 2018 repeat. Let's talk about that and more. And if you're new, then consider subscribing, and your like button goes a long way in keeping our channel in green. So make sure you hit the like button. So I read a very interesting article and it lays out time frame and also what to expect from our portfolios in the coming days. Now, news like that, or I should say articles like that, which are filled with numbers and facts, does two things. Either they make you feel good or they do not. And I read this a day after I opened some positions on Amazon and Tesla, which I shared with my Discord members. So if you would like to be a part of the group, then consider joining our Patreon and Discord. Links are in the description below. Okay, so article says we are seeing some red signs in the market, which resembles what we saw in 2018 or even 2008. I think 2008 is a little stretch, but 2018, well, let's look at it together. Okay, so let me share the article over here with you, and I'm going to actually point out a few things, or actually go over the article and then we'll point out a few things. Okay, so from what you see on your screen, it says everything from stocks and bonds right here is falling again. Even oil has pulled back from near records in a cross-asset sell-off, which echoes the rate spurt route of October 20 or 2018. Okay, then it says, with monetary support rapidly receding and recession risk rising, investors are hunkering down. Companies resilient to an economic slowdown, such as healthcare, are back in favor. The common denominator in each case is the fear of recession. Recession is in everybody's mind. Everybody is talking about how fast we are going to get into recession. Some economists are saying that 2022 will not be a year for recession. 2023 will be a year for recession, which I kind of agree with some of them. But let's read it together here. We are seeing a stampede into defensive stock and an aversion to economically sensitive stock. And that's why we saw this sell-off yesterday that we had. Okay, more than a week into April, soap manufacturers, drug makers, and utilities are dominating the list of winners among S&P 500 industries. At the bottom are chip producers and shipping companies, firms whose profit outlook is closely tied to the economy. All told, the world's most watched benchmark index is down 2.6% this month, and we just started April. Now, April is a big earnings week. But this April, of course, we will have the CPI data, which is coming out, or which has come out this morning. That is going to basically is going to tell us, I'm recording this before the release of the CPI data, and CPI data is expected to come about 8.3%. And I know that last time it was a surprise, and I think this time also it's going to be a surprise for the worst way. Maybe 8.4, 8.5 to expect from CPI. I don't know, 8.3 to 8.4 is my guess. Let's see what the market gives us. Okay, reading on. In a report earlier this month, Deutsche Bank AG strategist, the two strategists right here, said that they anticipate the S&P to drop 20% from the peak through late 2023. So 20% from the peak, and we're going to look at the chart together. But what does it mean for our portfolio? So let's look at the chart together and make sense of what the economists are saying. Okay, so this is, let me just quickly show you the S&P chart for 2018, and we are going to compare when they're talking about 20% drop that we can see. By the way, this is Moomoo. If you like the app, I really enjoy using it. Definitely take advantage. I have the link in the description where they're offering 4 free stock, and getting 4 free stock in these market conditions is beautiful because they have like amazing upside potential. Okay, so let's look at the indices and let's look at S&P 500 over here. So as you can see, it started in October of 2018, and they're saying that they are seeing the same echoes of the market right now as we had in 2018. And in 2018, we had about, I would say, 20% drop in S&P 500. As you can see, it went down to 19.4% from the high of 2018 S&P and then all the way down. So if you pay attention, the chart is looking, what they're saying, somewhat similar. And where we are right now, or the all-time high to drop 20% right here, we are talking about S&P to reach about 3,800 to about 3,900. Right here is about 20% right around there. So 3,800 S&P, they're talking about that we can see from all-time high. Now, Goldman Sachs has predicted that S&P to end this year is going to go about 3,800 is what their prediction was. Right now, we are flirting with about 4,400 range. So if you were to say that S&P is going to drop 20% from where it is right now, like today's value, we are talking about 3,500, and that's going to be devastating. Most of us entered the market high, and especially the growth stock. If S&P goes down 20%, growth stock is going to go down 50 to 60%. And 50 to 60% drop from where we are right now is going to be devastating, in my opinion. Totally brutal for us investors. Okay, so right now from all-time high 4,800, if it goes down to 2,800, we can see 3,800 level. Now, we have been in 3,800 level when we were coming out back in 2021, when we were coming out of pandemic and all the stocks were surging. In March of 2021, we crossed that 3,800 level, and since then we have taken a good flight. Now, one of the things that I would like to point out here is this. Look, so this is all major assets from stocks to bonds are in right here. It says in red. So this is the level. This is the S&P 500 level, and this is the number of red stocks, treasuries, oil, all of this. Look at the similarities. This is 2018. This is 2022. 2018, all the stocks, treasuries, and oil, everything was in red right here at the same level that we are seeing right now in 2022. So they're saying that stocks right now where we are at the same level. And I showed you in the chart that S&P 500 in October of 2018 was at that level when the stocks were in red. And since then, we know what happened. The stock market crashed till about December. So we had those rough 3 months where we saw all the stocks touches new lower lows, and all the growth stocks were getting killed. All the value stocks were getting killed, and people were basically taking out money from the stock market, those who bought at the high time. Okay, now let's take a look at this other chart. So this is a chart where they're basically talking about the call to put ratio or put to call ratio for VIX index. And this is a really, really key index right now. So this is March of 2022 just now, and we could see the decline as the market started to rally, or as S&P started to rally. We saw a decline in puts. That means people were getting more and more bullish. Now in April, this is the beginning of April, by the way. Since April, we have seen this steep increase in puts. That means people are getting very, very defensive in stocks, and they are buying more and more puts to basically hedge on the position. And the article actually describes that over here. Okay. Right here it says, all the same evidence of growth contraction is scant right now. The labor market is booming, consumer finance looks healthy, and corporate plans on capital spending remains robust. So whether the latest flight to safety stock reflect a growth scare or a valuation scare is up for a debate. I think this is more of a valuation scare, because now all of a sudden traders, economists, analysts, hedge funds, everybody is looking at the valuation. Up until last year, nobody cared about the valuation. It's all about the growth stock. It's all about future innovation. But now more and more people are caring about valuation. They're looking at the balance sheet. They're looking at the cash flow. They're looking at the cash reserves. They're looking at the earnings. And that's when they're deciding that, you know what, I need to hedge against my position. And this is what's going on, where they're buying a lot more puts now. See the increase right here? That's all happened in April. So they are basically now trying to be more and more, I would say, careful in their position and their hedging. So now I know one thing for a fact, that this is where I'll put my investor hat on and will make a very bullish statement. In my opinion, next 8 to 12 months will make some of us millionaires and some multimillionaires, because those who will keep their calm and keep the headphones on will make a killing as we get out of this drama. And this could very well take 12 to 18 months, but that's the beauty of the market. It serves them well who keeps calm, and it punishes those who think they can trade. Now, I plan on using my money, not margin, at this time, so I will get out of any open trades where I'm using margin, because it's going to get risky. But at the end of the tunnel has a bright sun. I can see it. I'm going to link my S&P death cross video over here, which told us technically that S&P is going to go down, but those technicals got defeated and we saw a strong S&P for a few weeks. And now some analysts are on track again. So we'll see how that goes. That is why I have a small account that buys every Monday, regardless of what the market conditions are. And I plan on doing every Monday going forward. I'll link my S&P video over here, so definitely check it out. And let me know in the comments, what are you planning with your money in these times? If I provided any value, then go ahead and give this video a like. And if you enjoyed the content like this, then consider subscribing to our channel. And yeah, Moomoo has a great 4 free stock offer, so definitely take advantage of that when you deposit $100. And getting a free stock now means you have an unlimited upside potential. So check out the link in the description below. Thank you for being here. Until next time, you all have a sparkling day.